Today, I would like to discuss a difference between Islamic finance and conventional finance on the topic of Islamic finance FIN546.
This is an overview of Islamic finance with conventional finance, where both finance have a risk, such as fire, tornado, eminent domain, and other risks. For Islamic finance, the risks are sharing, no riba, and no late payment fees, while for conventional finance, no risk sharing, have riba, and have late payment fees. First of all, I will recap back what is Islamic finance. Islamic finance is based on Sharia. Sharia basically means a way or path. In Islam, Sharia refers to divine guidance and laws given by the Holy Quran, the Hadith sayings by the Prophet Muhammad ﷺ, and supplemented by the juristic interpretations by Islamic scholars. Sharia embodies all aspects of the Sharia faith, including belief and practice. Sharia law is based on prohibition of interest, riba, risk sharing, prohibition of speculative behavior, gharar, sanctity of contract, and investing in unlawful business, haram. The first one is prohibition of interest. The prohibition of interest is founded on the prohibition of riba, a term literally meaning an excess and interpreted as any unjustifiable increase of capital, whether in loan or sales. This is the central tenet in mutual dealing. Riba is strictly prohibited in Islam. Islam allows only one kind of loan, that is Qardul Hasan. Next is prohibition of speculative behavior, gharar. Gharar means to undertake a venture blindly without sufficient knowledge or to undertake excessively transaction. Gharar involves a sense of legal trepidation. Commercial gain itself not prohibited, but uncertainty is forbidden. Taking economic initiatives that do not involve uncertainty is not that easy. Islamic finance prohibits transactions featuring speculation, including extreme uncertainties, gambling, and risk. Transactions in Islamic finance should be backed by real assets. Next, investing in unlawful business, haram. They do not violate the rules of Sharia quality for investment, which means that investing in unethical sectors such as casinos, tobacco companies, wine, and alcohol is totally prohibited. Only Sharia-approved activities are allowed. Next is risk sharing. Because interest is prohibited, suppliers of funds become investors instead of creditors. The provider of financial capital and the entrepreneur share business risk in return for share of the profit. Money as potential capital, it is a way of defining the value of things, should not be allowed to give price to more money. Last one is sanctity of contract. Islam holds the contractual obligation and the disclosure of information as a secret duty. This feature is intended to reduce the risk of symmetric information and moral hazard. Contractual relationships depend on the nature of transaction. Transactions in Islamic finance should be backed by the real asset. Next, we will discuss further on the differences between Islamic finance and conventional finance system. Islamic banking system or Islamic finance is based on the principle of Islamic law, also known Sharia, and guided by Islamic economy. The basic principle behind Islamic finance are sharing of profit and loss. Significantly, the prohibition of the collection and payment of interest. Collecting in interest is not permitted under Islamic law. For conventional banking or conventional finance, such as a commercial bank or business bank, is the type of the retail bank that provides services, such as accepting deposits, giving business loans, and basic investment products. A financial institution that provided services, such as accepting deposits, giving business loans and auto loan, mortgage lending, and basic investment products like savings account and certificate of deposit. The traditional commercial bank is a brick-and-mortar institution with teller, safe deposit vault, and ATMs. The differences between Islamic and conventional system. For conventional bank, the function and operating mode of conventional bank are based on fully man-made principles, while for Islamic banking, the functions and operating mode of Islamic bank are based on the principle of Islamic Sharia. The second one is the investor is assured of a predetermined rate of interest for conventional, while in contrast for Islamic banking, it promotes risk sharing between provider of capital, investor, and the user of fund, entrepreneur. For conventional banking, it aims at maximizing profit without any restriction, while for Islamic banking, it also aims at maximizing profit but subject to Sharia restrictions. For conventional bank, it does not deal with zakat, while for Islamic banking, in the modern Islamic banking system, it has become one of the service-oriented functions of the Islamic banks to be a zakat collection center, and they also pay out their zakat. For conventional finance, lending money and getting it back with compounding interest is the fundamental function of the conventional bank, while for Islamic finance, participation in partnership business is the fundamental function of the Islamic bank. So, we have to understand our customer's business very well. For conventional, it can charge additional money, penalty, and compounded interest in case of default, while for the Islamic bank, have no provision to charge any extra money from the default, only small amount of compensation, and this proceed is given to charity. Rebates are given for early settlement at the bank discretion. Conventional finance, very often it results in the bank's own interest becoming prominent. It makes no effort to ensure growth with equity, while for Islamic, it gives due importance to the public interest. Its ultimate aim is to ensure growth with equity. For conventional, interest-based commercial bank, borrowing from the money market is relatively easier. For the Islamic bank, it must be based on a Sharia-approved underlying transaction. For conventional, since income from the advance is fixed, it gives little importance to developing expertise in project appraisal and evaluation, while for Islamic, since it shares profit and loss, the Islamic bank pay greater attention to developing project appraisal and evaluations since it. Next, I will discuss on financial instruments of Islamic finance and conventional finance. Islamic finance instrument. Islamic market offer different instruments to satisfy providers and users of funds in a variety of ways, sales, trade financing, and investment. Islamic financial institution issues only equity finance instruments. The most common instrument is Murabaha financing for short-term investment and can also be used for long-term investment. Murabaha is like a markup instrument available in Islamic finance. It is cost plus profit financing for asset acquisition. Murabaha has some clash among Islamic scholars regarding its acceptability and applications in Sharia. The clash among the scholars is due to the selling of commodity which is not yet owned by the seller and charge an obligation on the buyer. The other instrument is Sukuk al-Salam, asset-backed security, which is used for liquidity management in Islamic banking system. It is an Islamic investment certificate or note which is parallel to yield bond of conventional bank and have the main motive of liquidity and tradability. Islamic investment sukuk is defined by accounting and auditing organization for Islamic Financial Institution 2008 as a certificate of investment of same value of share representing the ownership of tangible asset of the firm. While for wakalah is another important instrument used for liquidity management in Islamic financial system. Wakalah is an agency contract in which one party appoints the other party as an agent wakil by paying certain services charged against the task. It is a service provision. Unrestricted wakalah is the pool of funds in which funds are invested in any type of asset without impose any restriction. In unrestricted wakalah, Islamic banks charge only service fee rather than becoming partner in profit sharing. Unrestricted wakalah. Conventional financial instrument. Conventional finance has both types of financing, that is, equity and debt financing, and both types of financial instruments in market for trading. The first instrument is bill of exchange and other commercial paper, a financial instrument which are used in conventional banking for liquidity management as an instrument of debt financing. But in Islamic banking, its value does not depend on interest. Both systems have similar process, but the difference is on the market value of bill of exchange and principles of transaction. Conventional banks also use receivable at the accounts receivable or not receivable for liquidity management. Next is customer deposit are the other sources of liquidity management in banking system. Customer deposit his savings in banks and earn interest. There are different types of deposit in conventional banking system. Deposits of the bank depend upon the public preference. On the other hand, there are no deposits in Islamic banking, but customers act as a partner through musyarakah, mudarabah, and murabaha with bank. Actually, deposits are the loan which is given to commercial bank by customer, but in Islamic banking, customer act as a business partner with bank. The last financial instrument is ordinary share or equity share. Every share shows the ownership of the shareholders in the firm's asset. In Islamic finance, there are many types of shares that financial institutions issue, like share of musyarakah, share of diminishing musyarakah, share of salam, share of ijarah, hybrid securitization, and istisna securitization. The main difference between securitization in Islamic and conventional finance is that until the assets are not purchased by the firm, the share trade is not permitted in secondary market. In Islamic finance, securitization corresponds to assets, properties, rights instead of financial certificates. Islamic financial institutions can issue the share only against the assets to attain funds, but in conventional financial system, there is no need existence of assets against the share. The last part is value proposition. In Islamic finance, try to promote social justice. Islam and social justice are inseparable, and it's a key concept of the Islamic finance industry. The first is promoting adherence to Islam. A Muslim is expected to adhere certain core beliefs and perform certain obligatory acts by reminding Muslims of their obligation. Next is requiring zakat. To promote justice related to the distribution of wealth, Islam imposed a property tax called zakat to distribute to people in need. The next is defining the state's obligation. The state is also responsible for ensuring that social justice exists. Next, prohibiting usury interest. For the sake of social justice, Islam prohibits interest-based transactions. No individual or business entity should hoard money in order to earn interest or riba. Instead, that money should be used to support productive economic activities. Next, encourage share risk. Islam encourages risk sharing in economic transactions. When a risk is shared among two or more parties, the burden of the risk faced by each party is reduced. The last one is avoiding gambling. The Islamic prohibition against transactions that involve gambling prevent Muslims from purchasing conventional insurance products because those products are a gamble. Instead, Islamic insurance called takaful is based.
So now we have clearly discussed a difference between conventional finance and Islamic finance by list the operational mechanism of Islamic financial system and conventional system, and discuss instruments offered by the different institution and market in the Islamic financial institution, and we also discuss the value proposition of Islamic finance structure. So now I hope you guys can get information from my discussion of a comparison between Islamic finance and